Hey everybody, welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. We're here back again with Troy Cates from NEOS Investments. Welcome back, Troy.
Thanks for having me.
Absolutely. So you've been on the channel many times. We really appreciate all your time, and it seems to be a very popular suite of products that you are offering. So we've talked about your high income ETFs, your hedged ETFs, as well as some of your high income alternative ETFs. But today we're actually going to talk about your enhanced income ETFs. We've never really talked about on the channel before. And those include CSHI, TLTI, HYBI, and BNDI. But on a very high level, can you kind of explain how these enhanced income ETFs work and how they might be different than some of your other products?
Sure. So these products, as you notice, there's a name change. There's enhanced. And what we're looking to do is enhance the income off of what the underlying reference asset is giving. So we want to give whatever the underlying reference asset is putting out, plus some additional income source from the volatility of the options market. So for CSHI, for example, that's long 1 to 3 month T-bills. So that's giving you about 4% right now. We have an option portfolio on top of that to enhance that income. And that kind of goes across all 4 ETFs.
Okay. So with your high income ETFs, you guys are really pushing hard for the options income to pay the distribution. But this one is mostly the underlying plus a little bit of added enhanced income, if you will, just to give you that little bit of bump in yield. Is that accurate?
Yes, exactly. In the high income ones, we're using the call side of the option chain. We're selling calls to bring in that income. And in this scenario, we're using the puts. We're selling put spreads, and we're doing it a little differently, and happy to get into that on how we're rolling and what we're doing there to enhance the income of a 1 to 3 month T-bill or a 20-year plus, or for BNDI aggregate bond, or a high yield portfolio for HYBI.
Okay. Yeah. Thanks for that overview. Yeah. So with these being fixed income or, U.S. Treasury equivalent type of ETFs, it's very different than your equity ETFs that you have out there. As most people know, the market has been on quite a tear lately. It seems like every single week it continues to go up, even with all the other craziness that's going on in politics and economy and things like that. The stock market keeps on expanding. Now, these are more of your fixed income, so most people would consider that bonds or money market equivalent type of things. Where does something like this fit in with the market at all-time highs?
Sure. I think it fits into people that are a little more conservative in the market. They're not looking to be long, say, a QQQI or an SPYI and take a lot of equity risk and take that high income at the same time. They're looking more towards the fixed income market, and they really want to enhance their returns or their distribution that they could get from those products. So when you think about a product like BNDI, which is our Enhanced Income Aggregate Bond ETF, we're looking to enhance the income over an aggregate bond portfolio. And right now that's yielding, that type of portfolio is yielding maybe 3 3/4, 3.8%, whereas BNDI is giving you an extra 2+% on an annualized basis with the same standard deviation, same volatility profile as a core aggregate bond portfolio might give you.
Yeah, I think that's a really important part, is that the volatility and the what you get with this particular ETF is not adding much more risk, but you're getting that enhanced income based on the strategies you guys use and your option strategy and your tax loss harvesting and things like that you guys offer on these particular products. So if someone does right now have an equity portfolio and a traditional bond portfolio, where do these products kind of fit into that whole picture?
So you look at it as, if you have a traditional 60-40 split, as you're saying, and you're looking to get more income from, say, the fixed income side, this portfolio might pair up with a lot of what you already have in your fixed income portfolio. So if you look in there, we wanted to really have the duration of Treasuries. So we have the 1 to 3 month T-bill and CSHI, and then further out on TLTI is a 20-year plus. So you could pair those or toggle them back and forth to make your own mixture of what kind of duration you're looking for. With that, you're getting some additional income off of what you might. So if you're looking in your portfolio now and you're like, yes, I have 1 to 3 month T-bills, or I have an ETF representing that, you could look at CSHI and say, oh, I could possibly get some more income on a monthly basis over what I'm getting in that 1 to 3 month T-bill. And how does that work in your portfolio? Do you replace it? That's really up to the end investor, if it's a full replacement or it's an addition to help lower the volatility of the portfolio and help bring in some additional income. So really for us, we're trying to touch into, a lot of those different portfolio, fixed income portfolios. So if you have a portfolio that you're taking a little more risk, it's high yield bonds. That's where our HYBI might fit in, where you're getting an extra 2 to potentially 2.5% over the high yield bond portfolio. That's traditionally what you see in most people's portfolios.
Yeah, and that 1 or 2% extra that you're getting on your products over a traditional bond as a percentage of the increase in the yield that a traditional bond ETF gives, that's quite significant. So for instance, if a Treasury is paying 3 and you're offering 5, that's like a 60% increase, the yield you're getting on a monthly basis. So it can definitely benefit a lot of people who are looking for, safe, reliable monthly income, as you mentioned. So let's dig a little bit into each of the ETFs that you have to offer today, and just to kind of blanket all of them, they are all monthly payers. Is that correct?
Correct, exactly.
Okay, yeah. So that's really good for those who are looking for that income. You get a paycheck every month, and if I remember correctly, they're all kind of towards the end of the month. Third week of the month is when the payout is.
Yes, so it's traditionally, either the last week of the month, depends how the calendar falls, but it is towards the end of the month is when we pay. All of our ETFs are kind of on the same schedule.
Yeah, and you guys have such a broad suite of ETFs out there right now. They really does appeal to anyone. You have your high income, like your BTCI, which tracks Bitcoins and Bitcoin futures. You have your QQQ related one, your SPY. Related funds, and you also have hedge products, and you have these fixed income or U.S. Treasury equivalents. So you really do offer something for everyone's portfolio, if not a mix of, you can have your high income ETFs as part of your portfolio, you can have your bond related ones for part of your portfolio. So you guys really have come with a full suite of products, which is really great to see.
Yeah, I think when you think about NEOS, we really want to be a solutions provider. We
Mhm.
want to be able to offer something to everyone. And maybe you're not looking for something in the alternative space like a Bitcoin or a real estate and IYRI, but maybe you are looking for fixed income, and maybe this enhanced group might help, or you're looking for some high income off of your equity portfolio. So yeah, we try to look at it more as we're a solutions provider. We have 12 ETFs out now. Continuing to grow and bring out more ETFs and continue to slice up that asset allocation pie.
Absolutely. And just for everyone's disclosure, I am long many of your ETFs, and I really have appreciated having them in my portfolio. Just want to put that out there. So let's dig into each of the products. So I guess we'll start with our shortest term time frame, CSHI, your Enhanced Income 1 to 3 month T-bill ETF. So can you a few high points about what that offers and what kind of strategies you're using in that one?
Sure. So for CSHI, we're long a basket full of 1 to 3 month T-bills to get that underlying exposure. Then we're using that fixed income portfolio as collateral, and we're selling S&P 500 index put spreads. We roll this portfolio on a weekly basis. Duration is a little longer than a week, but we do roll it weekly, and that helps us in a few ways. It helps us to continually stay further out of the money from where spot is, because obviously the S&P 500 moves around quickly, and it also allows us to capture volatility spikes. If we have like a sell-off we had back in April, where we had this very quick, sharp sell-off, as we're rolling on a weekly basis per our rules-based model, we're able to capture a lot of that added volatility in the market and bring in additional income. A lot of people will ask, why do you use S&P 500 index put spreads over a fixed income portfolio? It's really because that's where the volatility is. We're sourcing income off the volatility of the equity market to enhance your fixed income portfolio. A lot of people look at that and they'll say, okay, what's my worst case scenario? Worst case scenario is a situation like April. Very sharp sell-off in the equity markets. When we're selling these put spreads for CSHI, we're usually anywhere from 8 to 12% out of the money. But when you have a sell-off that quickly in a week, you might go through some or all of those put spreads. And in that scenario, the option portfolio is going to take a loss. But what we saw in April was that volatility went from the low 20s to over 50 on a closing basis, and we haven't seen closes over 50 in the VIX really since COVID. We had a spike about a year ago to 60, and it closed in the 30s, but we haven't seen these consistent closes above 40 and 50 since COVID. So volatility really spiked from the tariff announcement in April. And with that, when we're rolling, we're able to bring in a lot more income on those rolls and bring back some of those quick losses that we may have had. And if you look at the performance on, for the month of April and going forward, you could see how quickly it captured back those losses and then continued to move higher. So it was a really strong test or testament to how the product works, how our rules-based strategy works on rolling on a weekly basis with duration a little longer. So for us, we really like to source that income for all these portfolios using those S&P 500 index options and selling those put spreads. And it kind of works along the same line for others, although the put spreads might not be in the same place for each portfolio because each portfolio has a different volatility profile. Each one is doing fairly similar in the sense that it's rolling on a weekly basis and it's selling these S&P 500 index put spreads to bring in the additional income.
And the drop that we had in April and then the rebound reminded me that you guys do offer or try to shoot for some tax loss harvesting ability within the ETF structure so that you can take advantage of that and reduce the tax implications. But you guys also utilize 1256 contracts. Is that correct?
Correct. So for all four of these fixed income or enhanced fixed income ETFs that we have, we use those SPX index, contracts, which are 1256 contracts. So you get that split, as you know, that's 60% long-term, 40% short-term on cap gains for the split.
Yeah, so these particular products might be more tax efficient than your traditional T-bills or your bond portfolio, which helps a lot when it comes to your total return that you get after taxes. So awesome. Okay, so CSHI, Enhanced Income 1 to 3 month T-bill ETF. Right now, as of recording, it's about 5.18% yield. Your expense ratio is 0.38, and it's been around since 2022, which I don't think a lot of people realize that it's been around. So you guys have seen some different market conditions while this project has still been outperforming other short-term T-bill type of ETFs. So that's really great.
This one, we're actually coming up on our 3-year track record at the end of summer, so we're excited about that. And most people don't know. Most people think of NEOS, they think right of our largest ETF, say SPYI, but CSHI was the first one to actually really gather some assets going into the end of 22 and then 23. Because you think about where we were in 22, we had this really big sell-off in the market. A lot of people were pulling money out of the market and putting them into a 1 to 3 month T-bill or cash-like products as the Fed was raising interest rates. So it got a lot of attention early on. So we've been really happy with how CSHI has performed and of course the asset raise over that time.
Yeah, no, it's definitely done well. And as I said, it has been outperforming other 3 month T-bill ETFs. So it's a really great overall packaging to get that higher income. All right, let's move over to BNDI, which you guys call your Enhanced Income Aggregate Bond ETF. So can you explain kind of again what that one does and what the main strategy is?
Sure. So this one, we're long 2 ETFs to get the long aggregate bond portfolio exposure. We're long AGG and we're long BND. We're long those equally 50-50. And with that, we get access to their portfolios, which have thousands of aggregate core bond portfolio building blocks. And then we're doing this similar thing where we're selling an SPX index put spread strategy, rolling on a weekly basis with duration a little longer. With this one, when you pair up the volatility, because what we're trying to do with these portfolios is always look at risk first. We're not looking at let's bring in as much income as we can. We're looking at the risk of the underlying portfolio and trying to pair as best we can the risk of the option portfolio with that portfolio. And when you do that, in this scenario, you're getting an extra 2 to maybe 2.5%, depending on the year, of income over whatever that aggregate bond portfolio is doing. So like I said earlier, that's yielding in the 3 3/4. And right now, BNDI is yielding 5.60 or so, right around that range. So you could see that added bump. But the nice part is if you look at the standard deviation of the core portfolio versus BNDI, it's right about the same. So we're not introducing a lot more volatility by putting the option portfolio in there.
Awesome. And that one, again, you do the tax loss harvesting if you can in the 1256 contract. So hopefully at the end of the year, you have a better tax situation than you would if you just held BND AGG. All right. So I'm showing that the yield is around 5.64, which is what you had mentioned. Expense ratio is 0.58, and this one again has been around since 2022. So you guys have seen a lot of different market conditions on this one as well.
Yes, exactly. This one's same. We launched CSHI, BNDI, and SPYI were our first 3 ETFs that came to the market in August of 22. So those are all coming up on their 3-year track record. So excited about that.
Yeah, that'd be awesome. Okay, so we talked about the really short-term income. We talked about your traditional bond type of ETF. Let's move over to the next one, is HYBI, your Enhanced Income Credit Select ETF. And for what I understand, this is more of a high-yield bond play.
Correct. So this has an underlying portfolio of high-yield bond ETFs, but there is a model to it where, depending on a few tactical decisions, it can move from the high-yield bond portfolio to Treasuries or more investment grade. So it can switch and rotate. So sometimes you might look at the portfolio, pull it up online, and see that it's in a couple of different high yield bonds ETFs and maybe a small Treasury position. Or sometimes you might pull it up and see more Treasuries as a percentage than you might have seen in previous weeks. This one's an interesting fund. It started life as a mutual fund, and they launched it in 2014. And it was just a total return high yield bond portfolio. We had the opportunity to acquire it last year, and not only acquire it, but convert it to an ETF and then add the option overlay to it. And when we were doing that, we changed it more from a total return, absolute return portfolio to an income producing portfolio that would distribute on a monthly basis. So this one's been really exciting for us to acquire it, convert it. It was our first mutual fund to ETF conversion we did during the acquisition, and then adding that option income. So this one has a really nice portfolio if you're looking for that high yield bond type portfolio. And this one has a very nice distribution rate, over 8.5%. When you think about your high yield bonds are right now in the 6.5% range. So you can get that added income from the option portfolio.
Yeah, the option portfolio absolutely is a big help in these. I mean, a 2% increase in monthly distribution is quite significant, especially when you're already in the high sixes on your high yield bonds. Now you're at 8.68 or so. When we're recording this, that's a huge increase for people who are looking for that income every single month. And I would imagine that if you're still reinvesting the distributions that go out every month, that actually helps with this particular product because you're getting that higher yield reinvested every single month.
Yeah, exactly. We know a number of advisors that will reinvest the distributions because they're looking more for a total return, but there's plenty that take the distributions depending on their client needs.
Yeah, that makes sense. All right, so this one's HYBI, Enhanced Income Credit Select ETF. Yield is around 8.68. Expense ratio is 0.68. And as you mentioned, this was started under your company in 2024, but the fund itself has been around for many years prior to that.
Yes.
Okay. And now moving on to what I consider probably your longest term bond fund, which is TLTI, your Enhanced Income 20+ year Treasury bond ETF. And I think most people understand what TLT is, but can you kind of explain how this one differs?
Yeah, we wanted to look further out for a longer duration, and we wanted to pair an option portfolio on top of a 20-year plus Treasury bond portfolio and give you additional income off that. This is yielding usually in the range of 2 to 2.5% over whatever your 20-year plus Treasury portfolio might be doing. And this is yielding just under 6.5% or so. And when you think about what your 20-year plus is doing in the 4.5 range, you're getting that extra 2%, which is meaningful when you're thinking about having a longer duration portfolio. We really wanted to do it because we saw the success we had in CSHI. And we had a number of people asking, saying, do you have anything with longer duration further out on the curve? And so we thought it might make sense to bring out this type of fund. So we're really excited about this. This one, we launched it right at the end of last year. So still, has some assets in it, but still trying to grow it and, make sure people know it's out there and continue to grow the enhanced income suite.
Absolutely. Yeah. So, I mean, most people probably know ever since, the Fed started raising interest rates a few years ago, the long-term bond funds themselves have been having quite a struggle, if you will. But, as rates come down over the near future, which everyone is expecting them to be, hopefully these long-term bond funds will start turning around as well. And so you could see some capital appreciation. But in the meantime, you're getting that enhanced income every month, which helps smooth out and also provide income no matter what the underlying is doing. So on this one, TLTI, We're showing yield at 6.46 and expense ratio of 0.58. And to your point, it was launched in December 2024. So only about half a year, a little bit over half a year on this one so far. All right, so thanks for going through all your enhanced income ETFs. Again, it's something for everyone, whether you're looking for just short-term place to put your money like the CSHI is, or you want to go the long-term or even high yield. You guys really do have something for anyone's fixed income or, U.S. Treasury alternative portion of their portfolio.
I look at it as, again, like thinking about your asset allocation, that there's a place for these funds or most of our funds in most people's portfolios. Outside of just picking individual stocks like some do, when you're thinking about having larger asset allocations within your portfolio, whether it's equities, whether it's a portion wants to be hedged equity, fixed income, or alternatives. And if you want to produce some income off of those portfolios, that's where NEOS comes in and can potentially help you.
Yeah, no, it's definitely, that's why I love you guys so much. All your funds are performing great. They give the high income and the strategies you guys have behind it between the tax loss harvesting and the 1256 contracts in most of your funds. It is more tax efficient than what you can get out there otherwise. Since we're talking about fixed income and treasury related ETFs, are there any other ETFs in that sphere that you guys are thinking about or might be coming out soon that you can talk about?
We're looking at a few different strategies within the fixed income portfolios. Nothing we could talk about now. The one fund we do have registered right now, hoping to get it out sometime in the fall, is an international ETF, so an international high income. So that's more obviously on the equity side with the added income from the options portfolio. So we're looking forward to getting that out. Excited to hopefully sometime in September, October timeframe.
Okay, no, that'd be awesome. I know a lot of people are really looking at the international side of things right now. So having an option that you can get some high income off of similar strategies that you guys have on your other equity ETFs, but international is going to be really appealing, I feel like, for a lot of people. So can't wait for that to come out. All right, Troy, thanks for coming on. Again, we talked about CSHI, TLTI, HYBI, and BNDI, all from NEOS funds, fixed income and enhanced income, short-term treasuries, long-term treasuries. You guys really do cover all the different aspects of someone's portfolio. So appreciate you coming on and look forward to talking to you next time.
Looking forward to it. Thanks for having me.
All right, thank you. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.